Well, welcome to Lunch and Learn. I can't believe that we're already looking at a new year. Back in October, we celebrated our fifth anniversary of Lunch and Learn, and we're looking forward to 5+ more years of the same. Lunch and Learn focuses on issues that relate to code and regulation, but also includes topics of product and business. And today, we're doing something that is like super, super important to new companies and frequently to those that have been around. Transitioning from carrying a tool bag to running a business is difficult. Most of us just got started and have the idea that if we have money in the bank, well, we're doing okay. Then in a few years that we have enough trouble just making payroll, can't even think about retirement or for ourselves or for our employees. So how do we make that transition from a tool bag to running a business? Well, today you're going to meet one of the industry's most highly respected and recognized trainers. She's done meetings and classes for Train and Johnstone and Lennox and Carrier and Goodman and Ream, and well, it goes on and on and on. She has books that she's written. I won't go into. Maybe she can share them with you. She's got a blog that you can subscribe to at no cost, and she'll tell you more about that. So who's this lady? Well, it's Ruth King. You need to imprint that in your mind so you'll remember to subscribe to her podcast and buy her books. She'll also tell you how she can come to your business and help you plan for success and one day get out of the attic and crawl space and focus on your business success. Miss King, Miss Ruth King, we're starting the year off right with you, and I am so glad to say you're here, and I appreciate you being here.
My pleasure, Tom. Thanks for having me. So today we're going to start with basically the basics, P&Ls, profit and loss statements. And if you get those right, then you probably can get just about everything else right. So let's get going. First of all, thank you for
All right.
being with us. I appreciate your time today and appreciate you sharing and keeping an open mind to what we're going to talk about today. So first question that I've got for you is, how do you generate revenue? And you're going to go, well, I sell something, or I have a service call, or I replace a
Yeah.
piece of equipment, or something like that, right? But go a little bit deeper. You generate revenue through billable hours. If you don't have a billable hours, if you can't charge a customer for an hour, then you have no revenue. We, as an industry, have to generate profitable billable hours. If we don't have a billable hour, guess what? You may still pay their payroll, but you can't, it's not revenue. If you have no billable hours, you have no service revenue, no maintenance revenue, no replacement revenue, no revenue, period. So you have to think not only, all right, I have to generate service work or maintenance work or replacement work. I've got to generate profitable billable hours in each of those areas, which allow us to do the work that we need to get done. And so I challenge you to look at how many hours you've actually paid your employees or yourself versus how many of those are actually billable. And if the
Ooh.
percentage is less than 75%, it's a problem because most replacement employees, field workers, however you want to call them, are north of 90%, 85 to 90%. Most service techs are north of 75, 70, 75% to 80%. So we got to get them productive because you paying them hours, yeah, you're going to keep the roof over their head, but they're not going to generate revenue and profit for you. So that's really the first thing that we're going to talk about. So, given the fact that we have billable hours being really, really critical to track, so what's the most important thing that you do every day? And I think I just gave you the answer to that question, which is to maximize your billable hours profitably. So, if you're paying a guy for 8 hours, can you bill all of those 8 hours? That's something you have to track. Now, the question is, can you bill those 8 hours profitably? Because if you're billing the 8 hours and you're losing $1 for every hour you bill, then you're losing your butt. So anyway, Tom said a little bit about me. I have been in this industry since 1987, and I have spoken with and helped contractors a lot of different areas, a lot of different trade shows, a lot of different speaking engagements. And Tom asked me to mention the 6 books that I have. And these are the 6. They're all on Amazon. They're all on Kindle. Yes, I read every single one of them. And you probably, if we're going to start with one, I would start with the courage to be profitable because it's basically what we're going to be talking about today. And that would be number one. Number two, once you get through that, you may want to just look at the 101 dumb financial mistakes and make sure you're not making any of those mistakes. And then read the others. They won't hurt either.
I read the 101 Dumb Financial Mistakes. Tom Turner sent it to me.
Uh-huh.
It offended me just a little bit because I think I had at least 100 of those. So anyway, go ahead. I'm sorry.
No, that's fine. It's like, you know, it's funny because you're saying exactly what people tell me all the time when they read that book. All right, I've made this mistake, this mistake, this mistake, this mistake. Crap. Excuse me for saying it that way. But, the book also talks about what you need to do to not make those mistakes anymore. So it's not just, okay, here are the mistakes. It's okay, here are the mistakes and here's what to do about it. So from there. Okay. So we're going to get into today profit and loss statement basics and looking at profit from there. And I want you to understand what profit and loss really are. Profit just means revenues were greater than expenses. That's it. Loss just means that expenses were greater than revenue. It does not tell you how much cash you have in the bank. All right. Cash is what is a balance sheet issue, and we'll get into that in another session. But profit is a P&L thing, and your P&L starts over every month and every year. So starting a brand new year, we have a brand new P&L. And I know all of us have had really lousy months. And thank gosh that month is over. And guess what? We get to start over with a new month the following month
Yeah.
and be looking at it from that perspective. Your balance sheet, on the other hand, started the day you started your business, bought your business, or one of the two, and will end the day that you sell your business or close the doors. So a balance sheet is a continuum. And again, we'll get into balance sheets later, but I want you to understand that a P&L starts on January 1st and can go through December 31st or January 1st through January 31st. And then guess what? Month of January is over. We get to start over again in February, through the 28th or the 29th if it's leap year. Month's over. How'd we do? And we start over again in the following month. And this is a P&L statement. It's just revenue or sales, and I'll explain the difference in a minute, minus cost of goods sold equals gross profit, minus overhead is equal to net operating profit. Subtract out other income and expenses, and that gives you net profit before taxes. Okay. So difference between sales and revenue. Let's assume you go out and you sell a $100,000 project. And that is not revenue until you actually bill it. That's the sale. But if you're going to bill it over 2 months, like 60,000, 40,000, whatever, the revenue is the amount that you actually billed. And this becomes really, really important from a maintenance agreement, maintenance plan perspective, because you may sell Mrs. Jones a maintenance plan and ask for upfront pricing for the year. That's a sale, but it's not revenue to you until you actually do the work. And it will screw up your P&L if you call it revenue and you haven't done the work, right? Because you'll have all revenue, zero cost of goods sold, your gross profit's 100%. Hey, you're doing great. And the months that you do the work, you have zero revenue and all that cost of goods sold, your gross profit's negative. And so your net profit's negative at that point.
Well, I've been there before and that hurts.
Yes, it does hurt. So those are the things that we have to worry about there, but that's the difference between revenue and sales. Okay. So I'm going to go through each part of the financial statement in the revenue or sales, net operating profit, all the way down to net profit so that you understand what goes in each bucket, so to speak. All right. Again, revenue is work that you generated and billed for in the accounting period. Sales are the work you sold, but not billed in the accounting period. And I gave you the maintenance plan perspective on that. All right. So again, remember how your company generates revenue. It's by billable hours. Now, which products and services do you produce? Is it residential? Is it commercial? Is it maintenance? Is it service? Is it replacements? Is it new construction? All of these can have different buckets, or you may lump them into one sum and just have your P&L be a total compilation. That's totally up to you. Okay. So the only way you're going to departmentalize is if you have one person who is in each department. So for example, if your service technicians also do maintenance, you're going to do service and maintenance in one category, in one bucket. If you have strictly maintenance techs, you can departmentalize your maintenance. If you have people who both do service and replacement, you just have one bucket for that. Once you have specific crews who do replacement only, you can take that into a specific bucket. Okay. Generally, that's with larger companies, but smaller companies kind of just have a tendency to lump everything together. All right. Cost of goods sold. Cost of goods sold is an expense that incurred because you generated revenue. All right. That's it. That's what goes in cost of goods sold. So, for example, these are billable labor. Remember I said billable labor because unbillable labor is not revenue producing and it's an overhead cost to you because you got to pay it
Mhm.
even though you didn't do revenue. Union dues for those of you who are union, materials and equipment, commissions, freight, subcontractors, permits, travel to a job site out of town. These are all expenses that you have because you sold something. Where I see contractors make a lot of mistakes is they forget to put commissions in here or, buy downs that you have for doing financing in cost of goods sold because you don't have that expense unless you actually sell the job. So make sure that your commissions are there and make sure that any financing fees are in there because that's a cost of doing business. So not cost of goods sold is unbillable labor, i.e. trainings, meetings, vacations, holidays. You're having them sweep the floor so that you can give them enough hours that week to have enough
Mhm.
money for food on their table. Materials purchased for inventory and stock, and a salesperson's salary are not cost of goods sold. Salesperson's commissions are cost of goods sold because he earned the commission because he sold something. The salary gets paid whether or not he sells anything. Okay. All right. Here's the maybe category. Maybe categories are like payroll taxes as they apply to billable labor and truck expenses. Some contractors put this in cost of goods sold, some do not. I don't care where you put it as long as it's consistent. My personal preference is to put payroll taxes and truck expenses in overhead cost. And let's talk about overhead for a second. And it's an expense incurred because you need to keep your doors open. Basically, that's it, everything else. So we have what I call payroll related overhead compensation expenses and non-payroll related overhead G&A expenses. And the reason I break out these two is because we want to know how much you're spending on all of your compensation expenses. Non-productive payroll, all of your salaried people, um, how much vacation and holiday, and how much 401k, and how much workers' comp, and all the fun things that we've got to pay so that we can keep our employees. Okay. So non-billable time, office personnel time, and then all owner's time that's not billable to a job. All benefits, workers' comp. That's basically compensation
Mhm.
expenses. And then G&A is everything else. And I only listed a few here: advertising, marketing, bank charges, professional fees, rent, vehicle expenses, you name it, everything else goes into G&A expenses. Okay. The other income part of it is something that is below what I call the operating line. This is income that you get not because you did work. All right. So if you have a savings account and you get 2 cents of interest on your savings account, that is other income to you. And it happened because you had an asset, not because you produced billable hours and billable work. You can also have gain on a sale of an asset. So what that means is if you have an asset on your balance sheet and it's zero, it's fully depreciated like a truck, and you sell it for $1,000, that $1,000 is other income to you. And yes, you get to pay taxes on it. Our lovely IRS tax rules. All right. Other expenses are cash paid outside of operational expenses. So like if you have one-time legal fees, that are starting up a company or you're buying another company, and these are legal fees for buying that company. It's not part of your day-to-day operation, so it goes into other expenses. And you can have a loss on a sale of an asset. So if the truck is, $1,000 on your balance sheet and you sell it for 500, you can take the $500 loss on a sale of that asset. So the other thing that I generally put in here is if you have callback expenses for work that was done in the previous year, I generally will put it here. If you have, callback expenses or warranty expenses for work that's done in the same year, I put it in to cost of goods sold or overhead, depending upon which it is. Okay. Okay, so that's your P&L. Revenue or sales, preferably revenue, cost of goods sold. Gross is equal to gross profit. When you subtract the two, subtract out your overhead, and that's equal to your net operating income. Subtract out your other income and expenses, and that gives you your net profit before taxes. And then you get to pay your taxes. Okay, we all get to pay our taxes. All right.
Lucky us.
Yeah. So that's basically what your P&L statement actually looks at. And if you have this right and you have everything in the right categories, then you're in a situation where you can truly see what the profitability of your company is. So most of the time on cost of goods sold, if you have an accountant doing your books, they generally will put all compensation in overhead rather than break out compensation to put the cost of goods sold and the labor and then your overhead compensation. If you don't put cost of goods sold labor in there, your gross profit's going to be wrong, your pricing is going to be wrong, and we can go forever from there. Okay. So that's basically one things that you've got to just be aware of and make sure that we have revenue and all the cost of goods sold that we have, including labor, above the gross profit line. That makes sure that we have our overhead proper and make sure that we can do our pricing properly. And then we can really take a look at what our net profit and our net operating profit is. All right. So
If I can interrupt you just a minute there, that to me is so critical. How does one price? Well, I know the way most people price when they, especially when they first get into business, they take the price that the company they work for was and they lower it just a little bit, saying, I'm going to make out like a bandit now. And yet they don't know how to price because they don't know all this other stuff you just went over. Golly, we need to get into this and learn it better.
well, here's, the way I look at everything is I look at it per billable hour. And we talked about that very, very first. So if we know that we have one billable hour, we need to know what overhead cost is associated with that billable hour and what profit comes to the bottom line for that billable hour. So it's very easy, at the end of the year, you just take your total overhead and divide by your billable hours, not your total hours, but your billable hours.
Mm-hmm.
And let's say that your overhead cost comes out to be $60 an hour. And I'm just using that number. I'm not saying it's good, bad, or indifferent, but you did the
Okay.
division and it came out to be $60 an hour. And you did the division, you took your net operating profit and you divided by your billable hours, and it came out to $7.21. My answer to question to you is why? If you can't make as much as you can make working for a McDonald's or another fast food restaurant, why in the world are you doing this?
That's a good point.
It's
Good
really,
point.
really important. So pricing is just simply a matter of adding up. No multiplication, no division, no nothing. So if we want a net operating profit of $75 an hour, which is the national average for service, I'm not talking replacement, I'm talking service. And we
Okay.
want that for $75 an hour. And we want our overhead, let's say it's $60 an hour. So our gross profit is 75 plus 60. And that's $135, and our guy makes $35 an hour, so 135 and 35 is 170. So if you could bill 100% of his hours, your hourly rate would be $170. But let's assume you can only bill 50% of the time. And so we
Oh,
have to take 170 and divide by 2, which is your billable rate should be $340 an hour. And before you go, I can't charge that. No, 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 no. Flat rate allows you to charge it from residential. On a commercial side, you can, depending upon, where you are, and, in Arkansas, I'm seeing rates now 120, 130, 140, 150 for commercial. But you do the same thing here and you just figure it out what it is and you look at it from a perspective of I'm not going to, multiply that by 2 for a flat rate perspective. And that's how you price. It's not hard. You just got to do it. No more multiplication, no more division. Know where you are from an overhead cost, know where you are from a net operating profit cost perspective, and work backwards. It's that easy.
If you know it, if we know what you have said, if we understand what the terms are and we know how to apply it, that it is easy. But if we don't know it, how do we learn it? We can't get it in just one lunch and learn. How can people get with you and you help them become profitable?
All right. So first thing you do is go invest in the Courage to Be Profitable. It's on Kindle. It's on thing. It's like $10 on Amazon. If you can't invest $10, we're not even going that far. All right. Be aware that on Amazon, I get about 50 cents a book. So I'm not doing this other than to help everybody and make sure everybody's there. If you want to buy the books directly from me, I can autograph them and then I charge you full price. Your choice from there. But anyway, what I would like to do with this group, because we're going to be doing more and more and more of this, is looking at it. Send me your financial statements the way they are. I'm happy to look at them to see where you are starting wise right now. Just send it to rking@financiallyfit.business. And if your statements are good enough, then I can show you how to subscribe to financiallyfit.business. But let's look at where you are first, and let's make sure we get you profitable and keep you there. And then you can do the rest of it from there. How's that? Would that work?
Sounds like a plan. Ruth, I've been trying to do something like this for years, and I never could find anything that was affordable because, the big guys, they've already got this. They've already got their accountants and they understand it. Little guys may have a bookkeeper, but the bookkeeper knows how to add and subtract. They don't necessarily know how to advise a service contracting business. We've needed so badly to find people who can advise a service contracting business on how to make a profit. I mean, as you mentioned a while ago, when it's all said and done, if you're only making what you could make flipping burgers at McDonald's, why take the stress of owning your own business?
Yeah, I agree. And I have a bookkeeper's course too. If somebody has a bookkeeper who needs knowledge, I find that most bookkeepers have a basic knowledge, but they may not understand our industry.
Mm-hmm.
And so you can just send me an email and I'm happy to send you that info too.
Well, as bad as I hate to say it, we're coming up on the end of Lunch and Learn, the time we have allotted. I want to thank you very much. And I want to say to everyone who's listening in that this will also be repeated on YouTube and you'll have the information knowing how to get in touch with Ruth. I hope you will proceed with that. Also, we've been talking to Ms. King about coming in and having a 1-2 day class here in Arkansas, and you guys could be able to come in and do it at an affordable price. Please let me know if you have an interest in that, and I will check with her schedule and we'll try to schedule something. We don't have to have 100 people. We just need a few people who really want to help their family and all of their employees by getting their business profitable. We always remind you that if you have questions about code and you need some help on getting your license renewed, contact the Department of Labor and Licensing. The email is adll.hvac@arkansas.gov. adll.hvac@arkansas.gov. There's really good people there that'll help you, and I think you'll enjoy having visited with them because they'll take care of whatever you need. Also, we'll be back in January. I believe it's January the 12th. Look forward to you being back then. And then a new announcement. In February, Tony Woodard, Chief Inspector of the State, will be back with us. He's been off for a few months. He's back on. We can't wait to have him back, and we'll be taking code questions, and he'll be answering them for you. See you in January, and then again, certainly in February when Tony returns.